about what excites you the most, how they all sort of come together, and ultimately what you think is most underappreciated by the market.
Sure. Yeah, I mean, it's a very exciting industry that we operate in. You know, if you think about luxury fashion, it's a $300 billion industry globally. It's a very resilient industry. It's proven over the last 20 years or so that it will, you know, it grows solidly 2, 3, 4% per annum, and you know has been able to withstand a lot of global issues, economic crisis, whatever it might be, and prove that you know it will grow. And I think that's you know largely down to the fact that it's a category, whether it's fashion or accessories or beauty, that is aspirational. People really want to buy into, and it's something that you know we see demand as an industry, you know, for a very long time to come. And yet within that, online has been very sort of underrepresented. It's had a very low penetration up and towards the pandemic of sort of say 19%. It accelerated, of course, over the last couple of years. And our belief is that, like every other industry, every other vertical, e-commerce or some form of online platform will transform the industry and really sort of allow it to transition from a largely offline proposition to more of a mixture between online and offline. And if you look at Bain or Altagamma's forecast over the next, say, 5 years, they actually think that 10% online penetration is going to get to something like 30% within that sort of time frame by growing pretty rapidly, 20-25% per annum over that time frame, as customers demand that brands sell more of their product online. And Farfetch, as you just touched on, is building a platform for that industry. It's the only large global technology platform that enables the brands to sell on a marketplace, a multi-brand marketplace. We have 3,500 different brands or designers selling on Farfetch at any one time, or indeed use the technology that we've built in the global operations solutions that we've built to power their own websites, brand.com, or retailers' online sites for that global audience. And importantly, we've been building aspects of the platform that allow us to really offer those brands more and more services. So you mentioned Fulfillment by Farfetch. This is a solution that allows us to use logistics providers around the world to be able to store product on behalf of our clients and get it to the customers much faster, better economically friendly, environmentally friendly as well. Or indeed, New Guards Group was an acquisition a couple of years ago now, which is an incubator, a brand platform that creates brands, delivers on the full end-to-end solution around production, manufacturing, marketing, distribution, and allows us to really marry up the Farfetch marketplace and the NGG brand platform to create exclusive content only for our customers, which really drives excitement from this customer who, as I say, is very aspirational. So building this platform allows us to provide effectively a very dominant position in the marketplace. We believe that Farfetch, as the only leading platform, should take a significant share of that $300 billion as it moves online and allow the brands and the designers and the boutiques to share in that growth.
Okay, great. So you guided to 28 to 32% marketplace GMV growth for the full year. I think that was better than people were expecting. Within that, talk about sort of the assumption around the underlying luxury industry growth, and then you have contributions from China, beauty, potentially new FPS partners. So sort of walk us through the bridge of how you get there.
Yeah, we don't break out specifics, but if you look at it, say, top down, you know, take that stat from Bain Altagamma, which says the market's going to grow 20% plus in the next year or so, and perhaps accelerate as we start to see things build over the next 2 or 3 years. And you think about Farfetch's positioning as that unique multi-brand solution. We've got more brands than anybody else. We've got those brands uploading more stock than ever before. We've got SKU count that sort of is 10 times more than most other multi-brand players for online luxury at any one point in time. And you know, we've got 3.8 million customers globally that we continue to add. That is fueling growth at least as good as that market. We should be gaining market share because of the dominant position that we have and the fantastic offering that we have. So, you know, I've always felt that the marketplace, from the characteristics that we have, would grow at least as fast as the online market, if not more. And then, as you said, you add in beauty, which is a new category for us. It's $75 billion of the $300 billion market. It's a category we've not played in until we launched this Q2 coming, so that will add incremental GMV. I think it's also got an amazing halo effect on the fashion and the accessories business as well, because customers buy beauty more frequently, and therefore Farfetch will be more front of mind to be able to buy clothing as well. And you know, we expect that to drive, you know, good level of customer retention and customer acquisition as we move forward for the year ahead. Plus, on top of that, as you say, we have a pipeline of FPS clients that we're very confident we will see come to market later this year to help continue to drive growth. And on top of all that, you know, we've been able to see that the China market, you know, take some really good learnings from the work we've done with Tmall over the last 12 months since we've been live, and apply those learnings to see an acceleration of growth from that channel within a very important market over the next 12 months as well. So overall, we're very confident that you know, 28 to 32% is the right number. We've also sort of looked at it by customer cohort, by our retention levels, our expected AOV, our frequency of shop, the new customers that we're adding per quarter. We've been, you know, recently adding 500,000-600,000 new customers per quarter. And when you add all that together, plus what we see from FPS, you know, 28 to 32% is absolutely the right number to go for. I should point out, the shape of the year is going to be lower growth in the first half than the second half. That's because we are comping over some pretty fantastic levels of growth this time last year. We were up 60% year on year in Q1, 40% in Q2, and then sort of roughly 20% across Q3 and Q4. And so if you start to annualize some of that growth and deliver that midpoint 30% overall, which ultimately would deliver a 2-year CAGR of about 32% as well, then the front half has to grow a bit slower than the second half. And there's also other reasons happening there. We are annualizing the effect of a new client with an FPS, Harrods, which went live, will start to become like-for-like rather than incremental as we enter the second quarter. And we're also seeing a sort of an impact from some of the COVID customer cohorts that says, Q1, Q2 will grow lower than that overall number, which I think most people now start to appreciate.
Okay. Maybe just touching on some of the current events. I think you disclosed in the 20F that you have 6% GMV exposure to Russia. Talk about how you're navigating that. Europe is obviously a much bigger market for you broadly. Was that sort of contemplated at the time of the guide?
No, I mean, it's obviously brand new. We guided before we saw impact in that region. Obviously, we've ceased operations and moving our focus elsewhere. The sort of one benefit, I think, of Farfetch to our clients is that we have a global customer base. When we've seen some markets struggle in the past, we've moved our demand generation spend, our focus around customer acquisition and retention to other markets to try and pick up some of that lost demand. Obviously, we've been very focused first and foremost on the people that are involved. We have a team in the area, which obviously we've been very focused on their well-being and looking after them. But as we've now sort of dealt with as much as we can in that space, for the moment, we're now focused on where do we sort of try and drive demand elsewhere to pick up the lost trade from the Russian market. It's also important for our clients. Obviously, the brands, the boutiques, the retailers that we support on the platform have also stopped trading into that market. They have product that we need to sell somewhere else for them, so we're very active to try and find demand elsewhere. Okay.
You mentioned a bit earlier about the customer churn from the COVID cohorts. I think churn was up a little bit in the fourth quarter related to that.
Yep.
Talk about what you're seeing from a retention and spend per customer perspective across cohorts, and how we should think about sort of net adds or active customer growth of the year.
Yeah, right. The net adds was about 100,000 customers between Q3 and Q4. That's sort of one of the lowest net adds we've seen. We're acquiring a significant number of customers. So we've 500,000-600,000 customers per quarter. We're now regularly doing that over the last sort of 6 or so quarters. It's been at that level. My expectation is we'll continue to see it add at that level moving forward because of the fantastic customer acquisition engine we now have. What's sort of slowing down the net adds is the COVID cohort from sort of around 2020, early parts of 2021. We have seen the dropout rate from those cohorts much higher than previous cohorts pre-pandemic. So the retention levels have dropped, unfortunately, for those cohorts, which is why you're seeing the net adds sort of move forward quite slowly. But I think once we get through those dynamics, we'll actually see the net adds pick up again. I'm confident that for the year ahead, we should see active customer numbers move above 4 million, roughly sort of, say, 18 to 20% growth on new customers year on year by the end of Q4. And that plus increased frequency of shop. We're seeing an improved AOV as we exit the pandemic, as customers start to trade up in terms of price point. We'll see good like-for-like growth from the vast majority of the cohorts in the year ahead.
Okay, great. One of the concerns I hear from investors sometimes is the brand's own DTC businesses are doing extraordinarily well, and so how do you think about that dynamic across the overall industry, and ultimately where do you see the market going from a breakdown of brands versus wholesale versus DTC e-commerce over time?
Yeah, they definitely. I think the biggest learning out of the pandemic for most of the brands is how important the online customer is. This last 2 years has seen strategies around e-commerce move from bottom drawer to top drawer. The brands have started to make their websites transactional rather than just sort of marketing focused. They're getting better at search engine marketing, at social media to drive traffic to their own branded website. So there is this sort of new competitor out there in some respects. We obviously focus on what makes Farfetch unique. It's not about a single brand shop. It's about being able to shop from 3,500 different designers. It's about making your basket look more like your wardrobe, which is something from a vast number of different brands. It's about the loyalty that you can get with shopping with Farfetch. It's the one-stop destination that you trust to be able to buy from designers that you may never have heard of. And vast majority of the 3,500 designers we have on the platform cannot power a website. They might not even have their own stores. They sell via boutiques, and so they definitely use Farfetch to be able to sell to the global customer, and we can then leverage that to attract and retain that 3.8 million active customer base. On the flip side, the brands are now realizing that actually their website is so important, and here, this is why Farfetch Platform Solutions, which is the product where we use our technology to power brand websites, comes into play. We've specifically built the platform to be multi-tenant at an enterprise level to be able to power the brands moving forwards, and so the conversation in that space has ramped up. So now that they've said that my my own website's super important, but the technology I've got is old and clunky, or it's not purpose-built for the luxury industry, or I need to add 5 different suppliers together to make it work. The Farfetch Platform Solutions product is a one-stop shop, built for the industry, built for global trade, and includes operations, logistics, demand generation, customer service, payment processing, order processing, back-end, front-end, you name it, in a one-stop solution. So the brands are super interested in what we have to offer to drive their trade. If you really step back and think big picture, brand.com sites probably should take 20%, maybe 25% of online as you move forward, because a lot of the sort of historical stats about customer shopping behavior suggest that 2 to 3 times they're shopping brand.com. They're very focused that they want that particular brand or that particular coat, but actually 8 times out of 10 they're just browsing. They're browsing a category, black cocktail dress or stiletto shoes or whatever it might be, and that's where Farfetch has the opportunity to really offer you a selection from the different brands. And this is exactly why, if you sort of move back to the offline world, why department stores were so successful at driving traffic, because the customer wanted to shop across all the different brands in one shop. It's the same thing online, if not actually, more likely that you want to shop multi-brand online, because who wants to have 80 different websites open across 80 different brands with your credit card details on 80 different websites to buy from different brands, and just rather do it on one site. So I think over time, that 80-20 rule will play out online, and that's where the marketplace is a dominant position.
Okay, that's really helpful. I think my next question was going to be around FPS, and I think it's one of the areas that is sort of underappreciated by the market. I guess how do you think about the long-term opportunity, either from a number of clients' perspective, revenue, margin? What are the goalposts that we should be keeping an eye out along the way?
Yeah, I think for me this is a key part of the long-term strategy. Maybe from a financial point of view to start with, the order contribution margin, that key variable profit metric that we monitor week in, week out, is significantly higher for Farfetch Platform Solution clients, already above the 60% long-term target I have for order contribution. That's because for the vast majority of those clients, we don't have to pay for shipping and returns and transaction processing fees and fraud and all of those different costs that are a deduction to effectively the cost of revenue within the marketplace. So it's a very profitable market, I should say, a division. It's already EBITDA positive as well within the platform dynamics. So every new client we add drives incremental profitability, and very, very appealing there from an investor point of view and from a financial point of view. If you think about why we really wanted to focus on that space, is because it's not only able to handle that 2 or 3 shops out of 10 that the brand direct websites will pick up overall in the industry moving forward, but also the solution works for retailers as well. And our largest client on FPS at the moment is Harrods.com. We power their global online operations, a large, obviously multi-brand retailer. They love the fact that it's a one-stop shop. There's no technical debt. They don't have to have huge in-house infrastructure in terms of their technology to power it, because we've obviously invested in all of that for them and on their behalf, and we can look after their global logistics and global operations if they want us to. So more and more retailers like that would significantly add to the GMV of FPS, obviously the profitability that comes through from FPS. And so I think over time FPS could not be 20 or 30% of GMV because it's brand.com focused, but it could be 40, 50% as we add more and more retailers to that part of the proposition as well.
Great. I wanted to touch a little on acquisitions. You recently announced the acquisition of Violet Grey within the beauty space, as well as one within the luxury resale sector as well.
Yeah, exclusive, yeah.
Yeah. Could you talk a little bit more about the acquisitions? What drew you to them, and then how should we think about acquisitions going forward?
Yeah. We obviously look at acquisitions to be completely aligned to our strategy, and obviously we've got a number of different avenues that we want to take. If we see acquisitions accelerating or providing us knowledge that we can't develop in-house, and the value is right in terms of what we see is accretive to shareholders longer term, then we will take those opportunities. Violet Grey, I think, is a good example of that, where we wanted to develop our beauty offering on the marketplace. It's a $75 billion industry, as we said earlier on, and we wanted to make sure we could start that with a pretty big splash. We obviously want to focus on third-party beauty suppliers, and we've signed up a number of large, medium, and small brands to go live in Q2 with us. But as we learned within fashion, owning a small retailer that allows you to understand how the customer works, how the supply chain works, how the dynamics of the basket works, and also use your 1P supply chain to perhaps create exclusives or capsule collections, or maybe plug gaps where third-party stock is not deep enough or not where we want it to be, like we've done with Browns on fashion. It is definitely the right thing to do to be able to have that mix of 1P and 3P. And so Violet Grey allows us to do that. We've got from the get-go an amazing supply chain. They've got some cult brands, some indie brands, the big brands as well. They really understand the customer in a way that we probably didn't know without that acquisition. And so we can use Violet Grey to really sort of accelerate and make sure that we start in that category from day one with a big splash. L'Exclusive is about resale. It's about making sure that we start to understand the customer dynamics in terms of pre-loved effectively. It's a boutique that has already been on the platform, so we could see it was already doing well, and understanding how that dynamic works by owning a small part of the market could lead to bigger things in the future.
Okay. It was also recently announced that New Guards Group will be the core operating partner for Reebok in Europe with an exclusive license there. Could you talk about the decision behind that partnership, and also sort of the financial mechanics in 22 and beyond?
Yeah, I mean, this is exactly what New Guards Group should be doing. It's a brand platform that can effectively develop and operate brands within the fashion space. This is bread and butter type sort of stuff. Obviously the distribution operating platform for Reebok is big in itself and is attractive in terms of what we can do around GMV on the brand platform, perhaps also on the digital platform as we might migrate some of the digital aspects of that brand onto Farfetch, or indeed through the marketplace. So very exciting just on its own. But what got us super interested was that ABG, who have now bought the brand off Adidas, were keen to develop the luxury end of Reebok, and obviously New Guards Group with Angels with Off-White. What we've done over recent years is an expert in turning all that crossover between luxury and streetwear, and have been able to drive growth in that market, which is obviously growing in terms of its popularity. And so we really think we can expand the opportunity for that brand in terms of luxury collaborations, exclusives, and really grow that end of the market for ABG over time. I'm super excited about the potential for that, and it does open the door for other opportunities for NGG to be able to power with other brands to drive growth and how to operate the business in a low cost and very efficient fashion. They'll obviously be able to source, produce and retail the product both online and offline, and use the leverage of the brand platform to drive that in a really good economical way and drive profitability for us. This year, there's a transition year, so 2022, it's a little bit complicated. The brand is in transition. We don't pick up the operating license fully until next year. We'll obviously start to work with both Adidas and ABG to develop products and things like that. So profitability-wise, it doesn't necessarily flow through from stronger GMV or revenue, but there is a sort of a profit share aspect to it that we'll be able to put into the profitability this year, and then from next year onwards see things really shift across different lines of the P&L.
Okay, great. Maybe let's close out on profitability.
Yep.
You delivered your first full year of adjusted EBITDA profitability in 2021. Your stated target is greater than 30% margins long term. Bridge us to that 30% over time. What gives you confidence that you can get there? Yeah,
absolutely. I mean, first of all, last year is a milestone for Farfetch, and I was absolutely delighted to be now in profitable territory. The guidance for this year is to move to 1 to 2% EBITDA margins to make us more squarely inside profitability and drive sustainable profitability as we move forward, as has always been the goal. The 30% is obviously long term, but quite straightforward to get there. Maybe if I work from that sort of 30% EBITDA margin up, our operating costs, our technology expense, our G&A costs, my long-term goal for that is to be around 30% of revenues. We're already seeing us head in that direction by driving very, very strong operating leverage year after year after year. We delivered 480 basis points of operating leverage last year, and my guidance for the year ahead is to have that operating element of the business at about 37% of revenue. So not far off the sort of long-term target of 30%, and yet we're still seeing significant leverage and scale coming through. The difference then, of course, is our order contribution, which I target at 60% over the longer term. That was 31, 32% more recently, so there is some distance to go. But the good news is there are parts of the business that are already at that 60% target. So I mentioned FPS already, Farfetch Platform Solutions, already delivering north of 60%. So as we continue to add more and more clients and shift the GMV towards that aspect of the business, we'll see the order contribution step up from that contribution. We're also seeing our media solutions, or our advertising revenue business, grow. At the moment, it's less than 1% of our GMV, but we have a target revenue of multiples of that over time. That has, again, significant order contribution flowing through, significantly north of 80%. Of the 80% level. So therefore, very incremental to the 60% order contribution. And we see that business growing as well. In terms of, say, the marketplace, we already have some customer cohorts at 60%. Those are the more mature cohorts that perhaps have less demand generation spend. We're engaging with them absolutely organically. Returns rates are lower, bigger basket sizes, and much stronger engagement with those customers, so driving those values up. So as we continue to see more maturity from our customer base, we will move naturally towards that 60% target away from where we are today as well. And then on top of that, we can continue to streamline our overall operation. So our logistics cost, which is a significant part of our cost of revenues, currently used as a fully distributed model. We effectively go to each of our sellers to pick up the parcel on behalf of the customer one by one. That means that we're shipping individual boxes around the world. We have a solution, you mentioned it before, Fulfillment by Farfetch, which is using third-party logistics solutions and warehouses to house that stock more centrally, closer to the customer, and therefore we can significantly reduce the cost of shipping and, importantly, the cost of returns. Sort of roughly 25% of our orders come back, so have to go back to Europe at this stage, but if we can hold those returns locally, then there's a significant reduction in cost. So we can see our cost of revenue coming down over time so that, on average, our gross margins increase as well. And then, lastly, we're looking at our customer engagement, which last quarter was 21% of our revenues spent on demand generation expense. We are improving our demand generation spend, moving more towards our low-cost channels or our organic channels. We're driving a lot of focus on personalization to be able to engage with customers on the app so that we don't have to keep paying for search engine marketing for them to return to the website. And that is also driving down overall the cost of doing business with customers and pushes that order contribution up towards 60%. So there's a lot of sort of levers there to pull to get to where we want to get to. Obviously, we continue to reinvest where we can to take advantage of the $300 billion industry. We're not in any hurry to get to 30%. We see the opportunity to reinvest most of that over the next few years to build towards that bigger opportunity. But long-term, 30% is very much within sight. Okay.
We have 90 seconds left. What excites you most ahead in 2022?
For me, the FPS pipeline is super exciting. I think, as I said earlier on, the industry has woken up to the fact that online is a very, very important channel moving forward. And FPS is a fantastic product that enables brands to just effectively offload all of the unnecessary or the necessary perhaps work that's needed to sell online to a single supplier. We have a very strong commitment to partner with brands to work with them around their trading strategy, their demand generation strategy, their customer engagement strategy. Moving online within luxury is not as simple as just flicking a switch. There's a lot of hand-holding, a lot of consultation, a lot of work. And Kelly, who's our Chief Product Officer, her team works more closely with brands around how to trade online than actually the technical side of it, because that is now very bread and butter for Farfetch. So moving across the Farfetch platform solutions not only unlocks an amazing technical product, but a suite of services to help you really drive your online trade. So, yeah, with 19 seconds to go, I guess that's probably the most exciting opportunity for us as we move from this year and even into next year.
Excellent. Thank you so much for your time. Thanks, everyone, for joining us.
Thank you for having us.